assets in global private markets have grown significantly since the 2008 financial crisis, with the amount of cash reserves available for private equity buyouts reaching new heights at the end of last year. We're talking an estimated $1.96 trillion. Staggering. But private equity groups are now also competing directly with the largest Wall Street banks to provide financing on the biggest takeover deals. And at the same time, they're offering alternatives to public market IPOs as a channel for fundraising. So how is the economic and monetary environment affecting this booming sector? And where are the key opportunities for further growth? Tackling this topic, we welcome Christian Sinding, who is the Chief Executive and Managing Partner at private equity firm EQT Partners, one of our global boardroom partners. Antoine Flamarion, he is the co-founder of Tikehau Capital. Kai Schneider, partner at the law firm Clifford Chance and also a global boardroom partner. And Jennifer Hughes, the US markets editor here at the Financial Times. Antoine Gara, the FT's US private and institutional capital correspondent, moderates.
Welcome to today's panel on private markets and where the current economic environment will support the industry's further growth. With us, we have a wonderful lineup of panelists. We have Christian Sinding, who is Chief Executive of EQT, one of the world's largest alternative investment firms. It manages 332 billion euros among strategies like private equity, real assets like infrastructure, and real estate. Christian has been with EQT for a quarter century and steered the firm through its 2019 initial public offering. EQT has since grown its assets by more than fourfold. Antoine Flamarion co-founded Tikehau Capital in 2004. The private capital firm manages 41 billion euros across strategies like private debt, real assets, and private equity. Tikehau, which is headquartered in Paris, is also publicly traded. Prior to founding Tikehau, he worked at Goldman Sachs and Merrill Lynch. Kai Schneider is a partner at law firm Clifford Chance, where he advises private capital groups on the formation and investment in private equity funds, private real estate, infrastructure, and credit. He is a member of Clifford Chance's Global Executive Leadership Group and leads the firm's global focus on financial investors from its Singapore offices. Kai is also co-chair of the executive committee of the Singapore Funds Industry Group, among many other commitments. And finally, with us, we also have Jennifer Hughes, the Financial Times US markets editor. She's been with the Financial Times for almost 2 decades and has worked out of our offices in New York, Hong Kong, and London. I'm Antoine Gara, our U.S. private capital correspondent. Our panel is covering the growth of private capital in this new economic environment. And it's a time of great change in markets, particularly the cost of money. We will be taking questions from the audience at the end of our session, so please send through questions through the chat feature. So to start, I think it's important for us to cover the basics of the state of play in private markets currently. And so, Christian, what is this new normal like, and what are your investment biases? Is this a great time to invest right now with interest rates having risen substantially through the course of the past 18 months?
Thanks for the question, Anton. I think it's a fascinating time now, actually, in the markets. And yes, of course, we're all talking a lot about higher interest rates and the impact of those on valuations and on companies and capital structures. But I think the reason that there's kind of a lower volume of activity in the market now is actually the uncertainty that's out there, and the uncertainty coming from continued inflation. Well, where will interest rates end up? There are geopolitical questions. And we've been through a cycle, which was the fastest cycle we've seen in private markets ever, actually, even faster than just before the global financial crisis. So it is a time where people are, trying to be a little bit more thoughtful. But at the end of the day, if you look behind the scenes, at least in our firm, there's quite a lot of deal flow. There's quite a lot of activity. There are a lot of discussions going on. And I think this is an interesting time when certain corrections have come to valuations, whether it's growth companies or biotech or other things, and the public markets are volatile. This is actually a pretty interesting time to find some great companies that we can invest in, build for the long term.
Antoine, your firm, does private equity. It's also a lender. So what are you seeing, and what is Tikehau up to these days?
Yeah, echoing what Christian just said, it's probably one of the most exciting period, because we're seeing that, after the big party, there are major changes, geopolitical, political, social, macro, interest rates. But that's create, a unique set of opportunities. So we see really two sets of opportunities. The one we call defensive, it will be stressed, distressed credit, direct lending, and secondary real estate, secondary private debt, secondary private equity. And we see also a bunch of offensive, and it will be sector specific, for instance, energy transition, cybersecurity. So we are fairly excited, but we think that valuation needs to come down much faster, and it's taking time. Obviously, we are coping with probably one of the largest real estate crises in history. So it's going to be super bumpy. There is no doubt, but also for agile, nimble people with dry powder, probably a unique set of opportunities, I guess.
And Kai, you advise a number of private capital firms. What are you seeing? Are they, in this new environment, are they pushing out their investments? Are they delaying things? Or, as Christian said, are you starting to see people really start to begin to step in from the sidelines?
So I think I would also echo what Christian said. Yes, it's been a slower year. And I think that's really more due to the uncertainty rather than interest rates, frankly. One of the observations, I think, just to add on what was said, is that with interest rates being higher, the cost of financing is more expensive, obviously. And so we're seeing more or larger equity contributions. So deals are still happening. It's just the way they're being structured, the amount of leverage on them is changing. We recently advised Brookfield on an acquisition of a UK renewable energy developer, Banks Renewables, an example of a very large deal with less leverage than maybe would have been on there in other markets. And then I think on it's not just deal flow in terms of deployment, but also on the exit side, that's been muted as well. So obviously lack of IPOs, and that's leading managers to think about other liquidity alternatives and be a bit more creative in generating cash flows from investors. So it is definitely an interesting time for our clients.
And so what are the ways people are being creative? We've certainly focused our reporting on some new features, but tell me what you're seeing.
Yeah, so there's a few different ones. Obviously, NAV financings have made a lot of noise in the press, and we've seen managers either looking at that, exploring that as an option, or actually executing that and looking at that to create more liquidity for vintages where there isn't necessarily that much activity on the exit side. The other is around secondaries and continuation funds. So where there's a bit of a mismatch between possibly the maturity of a portfolio company or a number of companies in the portfolio and actually the timing in terms of that investment cycle and divestment cycle of private funds, which is pretty fixed. And so we're seeing more and more secondaries and continuation funds being used to, again, create some of that liquidity for investors.
Christian, we've talked about this in the past. Ways to find liquidity or house investments. If you want to own them for longer, but not necessarily sometimes touching on the public markets themselves. So what do you make of the trends that Kai is seeing?
They're real, and I think all of us are trying to find alternatives to generate liquidity for those investors who need liquidity, and longer term capital gains for those investors who want that. And what you and I talked about some weeks ago, Antoine, was the concept of a private IPO. At EQT alone, for example, we have 1,200 institutional clients, LPs, plus private wealth clients. And in a typical IPO, there's only a couple of hundred investors. So we thought that rather than going public, and we can talk about the challenges of the public market if you'd like as well, but there are some real challenges to the IPO markets. Maybe the simplest fact is that the volume of IPOs is down more than 60% since its peak before the financial crisis, and companies are staying private for much, much longer. We figured maybe there's a way for us to actually create a market in our own companies and match sellers and buyers of shares in that company in the private market, and then continue to run with that company and build it for the long term to maximize its potential. So that's quite exciting, and it's kind of a play on the continuation vehicles. But on the continuation vehicles, you have the secondaries players who are providing a lot of the capital, and here would actually be us as the GP and the LP then just doing it directly, which we think could be exciting.
And Antoine, with sort of the public market not offering the same liquidity it did in 2021 or 2020, are you seeing opportunities to put your assets to work, to firms that need it, to companies that need it? What are sort of some of the conditions you're seeing, given that you're acting as a lender, and also have strategies in more tactical investments and just straight private equity as well?
Yeah, I mean, because of what we described, there is no doubt that providing financing is much more appealing right now. I mean, you're lending obviously at higher rate with lower leverage. So we are, very happy to put more capital at work. Also, there are less deals available, but I think the set of opportunities for direct lending is becoming more appealing. It's probably bigger, especially in Europe, because we are very late when it comes to disintermediation if you compare with the US. So probably I suspect that Europe is probably more appealing from a direct lending point of view. And to your precedent question, there are more and more opportunities to provide liquidity, and the disintermediation is true on all aspects. It's financing, obviously, but bringing liquidity to LPs, to portfolio companies. I think we are probably just at the beginning of that, and it may come in a digital way as well. We launched our own digital platform providing liquidity solution as well, called Opal Capital. So I think, markets are changing. There are no doubts, but, there are a lot of money outside, a lot of dry powder, a lot of opportunities, and it's a question of, matching that in a very different ways. But opportunities are there.
And Christian, like with the rise in borrowing costs, has the math on just making a classical private equity investment just fundamentally changed? Has it caused a friction where you just don't want to transact because of the cost of capital? Or, as Kai said, are you just putting more equity into the deal and sort of solving for the rising cost of capital by either doing unlevered buyout, which we've even seen this year, or something where you just don't have the same leverage that you would have in the past?
Yeah, it's a good question. Actually, one of my colleagues said the other day that this is a much more exciting time than 2 years ago, and everybody's like, "Why are you saying that?" Well, this is actually a time where you need to invest more fundamentally and create fundamentally better companies and create value by growing the businesses organically or through acquisitions, driving innovation, removing inefficiencies, focusing on cash flows again, which is kind of healthy. So moving away from the financial engineering that was there for a while and the multiple expansion to more fundamental investing, I think suits us as an industry, or at least a lot of us, pretty well, I think. And yes, is it more challenging? It certainly is, because the cash, the valuations need to come down somewhat because there's more cash going to the credit providers, everything else equal. But if you look at the history of interest rates over the last 20 years, we're actually just back at the average over the last 20 years. So this is not necessarily a big shock, and it's never happened before. It's just that it went so quickly from zero interest rate and everything was going to the moon to, okay, now we need to think about fundamentals again. And I think it's pretty healthy, actually, these corrections. And it brings us back to why ultimately was this industry created? It was either to find inefficiencies or to find, or to use a better governance model to drive the transformation of companies to the future and therefore generate returns. So we're strangely excited about this next period, even though it certainly is, it's hard day to day. It's a little rocky still.
Okay, strangely excited is a really interesting way of framing it. I wanted to bring Jennifer Hughes, our U.S. markets editor, in to the conversation. So one of the things we've been talking about at the FT and have been writing a lot of stories about is the new normal. And so Jennifer, maybe why don't you give us a little bit of a rundown in terms of what we've seen in recent months and what you think it means in terms of moving out of that low interest rate world and into a new higher interest rate world.
Sure. And this is a great discussion to be having and a good time to be doing this as well. I think the main thing for me is, you're right, Christian's right, we're going back to what was a long-term average, but it's such a long time since we've seen that for me, I still feel that this year is, you ain't seen nothing yet in terms of what rates might do. I'm not personally expecting them to spike much higher or the Fed to suddenly jack up rates much from here, maybe. But this is going to be the grind, the higher for longer sense. And Antoine, you've written a lot about this, the private markets too. This sense that at the moment we're starting to see some problems in corporate credit, and these will grow as rates stay higher, and refinancing where people are going at the moment. I hope by the time I have to refinance that interest rates have eased off. I'm not sure they're going to so much. So I can totally understand why this is a very exciting time for Antoine, for Christian, for all of you, because there's so much going on. It's certainly exciting to be writing about as well. I just think the next year is going to be even bumpier. So that's going to be opportunity, as you say, for dry powder that you've got. But it's the existing investments, I think, are going to cause more headlines, or the stuff we'd like to be writing about, and some of our panelists here might not want us to be writing about.
Well, Kai, you led us into this discussion, and it's a great one. And so the point you're making is people have been finding liquidity. Some of it is from novel places and from different forms of financing. Do you view these as sort of temporary solutions, or are people, using this market to put in place things that are sort of long-term capital structures or long-term solutions? Or are we in sort of a kind of kicking the can type of environment, and people will wait to see a few years from now where everything really settles out?
So I don't think it's a matter of kicking the can down the road. I actually think, if you step back and look at secondaries on the sort of, single asset side, it's been there a while. Typically, it was more focused on, portfolio companies that weren't performing, and now you're seeing it being used for some of the crown jewels, the higher performing assets in a fund. But it's simply, from my perspective, really just a mechanism to deal with some of the fixed restrictions around a typical private fund, where you've got, as I said before, sort of 5-year investment period, say 5-year divestment period. And because of the markets, because of some of these issues we've been talking about, portfolio companies just aren't reaching their maturity or not necessarily, at the point where managers want to exit them in those timeframes. And so, the GP-led secondaries are giving managers, giving investors the opportunity and the ability to stay with those assets for longer and for a longer cycle. So, I don't think it's kicking a problem or, as you said, a can down the road. It's really taking, well-performing assets, thinking about, future strategic acquisitions, more development, more growth, and what they could be, and then riding that on and allowing investors to exit and get liquidity if they want, but also to continue to be part of that story. So I do think these are longer term trends and themes. Same with continuation funds that I think we'll see, well past the current sort of issues we've been talking about.
And is there new capital coming in and enough sort of capital in those markets to provide liquidity for the existing stock of private equity investments that sort of is nearing that kind of need to exit time period? Back to you, Kai, again.
So it's definitely one of the large areas for fundraising at the moment. So there's a lot of activity in the space. I think it depends a little bit on geographies as to whether there's a match or not. If I look at APAC, for example, where I'm sitting at the moment, there's quite a lot of opportunity, but not probably enough sophisticated capital to take advantage of it. So it depends a little bit. I suspect it's different in Europe. So it is, it's a hot area of the market, and as these opportunities continue to materialize, people will take advantage of it. I think it's also worth saying, Antoine, that some of the skeptics around this in terms of funds selling to funds, I get that, I understand that, but I think the market's developed various protections and mechanisms around that. Dealing with conflicts, dealing with valuations, independent valuations, approvals by investors or, advisory committees, fairness opinions. And, I'd argue that really these GP-led transactions really only happen if it's win-win-win. So if the seller, it's a win for them, buyer, it's a win for them, and it's a win for the GP. So it really, it's not happening where there's a losing party.
Great. And Antoine, what are you seeing in terms of the opportunity set, in terms of things you find attractive right now? Obviously, credit, everyone says it's the golden age of credit, but where are you focused, and what types of opportunities are you seeing and focused on in the immediate term?
Yeah, maybe people have been using leverage more or less everywhere, in infra, in real estate, in buyout, obviously, and we're seeing that obviously it's suffering. So probably the first big set of opportunities is coming from real estate, and real estate has been the combination of various things, obviously. Interest rates, but now there is scarcity of financing. Valuation have been totally crazy, and we start seeing rents declining all around the world. Office, no doubt. Retail, no doubt. So we spend more time on real estate, and it's about buying buildings, buying loans, providing new financing, doing secondary real estate, and there are only few people able to do that. The bulk of the people are focusing on secondary private equity. So we start seeing some very good opportunities in real estate. That would be number one. Direct lending, we discussed. It's probably super appealing, not because everybody gets overexcited, but it's just you're lending at higher rate with lower leverage, so the risk reward is much better. And as I said before, there are some sectors which remain super appealing. Energy transition, and I'm talking about company, not assets, is super appealing. We are just at the beginning of that, and we just IPO a company in Italy, despite the fact that market for equity capital market are challenging. But we see a lot of opportunities there. Cybersecurity, as I pointed, is another example. So there are tons of opportunities. We are not really focusing on what Kay has been describing, and NAV financing or continuation fund. We are not big fan of that, right or wrong. But we see enough opportunities everywhere with the right risk reward.
And why not a fan of things like continuation funds?
Because it's we see that more as artificial liquidity, and it was your comments on pushing the can, and I think everybody has his own view. It's good to provide liquidity, there is no doubt, but we like brand new situation, and I'm not saying that all continuation funds are wrong, not at all. But we think that there are more risk reward or better risk reward elsewhere.
Great. And Christian, back to you. I think you said you were scarily excited or something, sort of putting you a bit on the fence. But in terms of what you're excited about, what is it?
Well, if you look at our business, it spans across everything within private capital, from venture capital all the way through buyouts, in number of infrastructure strategies, and also real estate. So across those, the themes that we're excited about are some of the ones that Antoine reflected on. The energy transition, I would say the decarbonization of society, actually, all the way from ventures throughout all the businesses. Is a big theme, and something we're doing, both in terms of growing new companies, but also transitioning companies from gray to green. That moves into things like transportation, actually, which might sound quite boring, but if you think about ferry systems, for example, we're one of the largest ferry companies in the world in the Nordic region, and I'm from Norway. To have ferries going across the fjord, and when they're decarbonized, of course, they're much, much, much better for local environment in terms of noise pollution, in terms of air pollution, in terms of the health of the the local, let's say, nature. And when it's decarbonized and it's electrical, it's totally silent, and the company becomes much more interesting long term. You get longer contracts, you get specced into that fjord. So this congruence between making companies more sustainable for the long term and creating financial value for our investors, we're trying to attack from all different kinds of areas. We still think there's a lot to do in digitalization, both in the physical economy, like data centers and fiber optics and these kinds of things, and into software. And then healthcare is maybe the final one where we still, even though there's been a big correction in life sciences and biotech, the need for a healthier world and a healthier planet for people as it's aging is also big. So, these big themes are quite exciting, and then you need to break them down and find out sources. And the sources now are changing a bit. We're back into public to privates. We're back into carve-outs. We're doing partnerships with families, which we think is very exciting.
So those aren't really like waiting for distress or waiting for some balance sheet event to allow you in. Like a carve out sounds like a little bit more a healthy asset, but you're providing liquidity to the corporation or strategic focus to them. Or are you trying to wait for really distressed valuations, or are you trying to pay a fair price for a business you think you can make much better in the coming years?
Typically the latter, but in real estate, I think it's a little different. That there's a lot of distress, and there, there's quite some exciting opportunities to even to buy from banks that are not interested in taking over assets. So yes, we're looking at that, but we're kind of agnostic to the source. It doesn't really matter what the source is. What we're trying to find are the right opportunities, and we're happy to pay market price for those opportunities if we think that we can add value to them, whatever they may be, and accelerate their development. Back to what I commented on earlier. So having this, picking the themes that you're investing behind, and then going in to try to find, how do you get there early and win that corporate carve out. And there, it's been a while since corporate carve outs were popular, because capital was cheap, everybody was growing, multiples were high, it was fine. Now there's a totally different corporate agenda. You need to refocus on your core. Cash flow matters, balance sheets matter, et cetera. So whether it's distress or not distress is not so important for us. But I think there's the pressures that we're seeing now in this uncertainty we're in will lead to more deal flow over time. Yeah.
And Antoine, Christian has just mentioned the ability to take real estate assets off of a bank balance sheet. Is that an opportunity you're seeing? And where specifically were you seeing the real estate opportunity that you had mentioned earlier?
Yeah, I think, because mainly of interest rate environment and also quantity of money available. If you think about it, after the global financial crisis, the sum of the four central banks has been multiplied by 10. If you look at their balance sheet, and the bulk of this money has gone into real estate, and that's true more or less all around the world for any kind of real estate, from resi to logistic to office to hotels. Now it's going the other way around. It's almost impossible to refinance a large portfolio. So we see probably several set of opportunities. One is lending to real estate owner, existing portfolio or new acquisition, lower LTV, higher margin. That will be one. We start seeing some stressed and distressed real estate, and we've done that only a few times, probably back during the saving and loan crisis in the US in the 80s, in Europe in the 90s, not so much during the global financial crisis, but now, no doubt, you could be able to tackle opportunities everywhere in real estate, and we are talking about very large amount of money or assets. So we spend a fair amount of time sourcing, expanding our real estate capacities, and that will be debt and equity. And as I said, also secondary. There are only few people able to do secondary real estate. And as you notice from around the world, which is the French SCPI, the BREIT in the US, there is a huge queue of people trying to exit. And by the way, that's the same guys who provide capital to private equity, to infra, to private debt. So it's pension fund, insurance company, and so on. So there is also a play of bringing liquidity there. But the opportunity is very big in real estate. It's more or less everywhere, probably a part of Middle East. But even in Asia, we start seeing some difficult real estate situation. So real estate is probably a giant opportunity. Yeah.
And are transactions actually happening yet, or how long will it take to actually put these together? Are the banks actually selling? Are they sitting and waiting, and this is sort of a period of forbearance? What is the timetable?
I think what you see, and fairly similar to what's happening in the private equity space, is that there are less transactions. So we cannot say that there is a fluid market. So people consider their assets are worth 100, and the only bid is at 50 or 40. So it takes time. So we are just at the beginning of that. You start seeing few banks who lend money, who repossess assets, and now they are selling. Bank One in the US just announced that they are offloading a portfolio of commercial real estate loan. Few European banks started that in Germany and in France. But we are frankly just at the beginning of that, and it's going to take some time because the price discrepancy is still very, very large.
And Christian, what do you see in terms of the real estate opportunity that we've just been discussing? Are these things potential transactions you could see EQT putting together in the next year, or do you have to be fairly patient for these assets to begin moving?
Yeah, it's still correcting itself. The biggest part of our real estate business is in the US and in logistics, and even there, which is one of the most attractive sectors, there are challenges. And one of the largest banks, I heard earlier today, typically finances $25 billion a year in new real estate financing. And now they're down to $4 to $5 billion. So about $1 billion a quarter, absolutely nothing. So the pressures that are coming are real, but we still have ice in the stomach, as we say in Scandinavia, for some time. But 2024 into 25, I think, will be quite an exciting time for real estate. And there's going to be a shake out there. I think, everybody sees it. It's the most interest rate sensitive area within the private markets, and that correction will lead to some interesting opportunities for sure.
Yeah, and Kai, being someone who's at the table as people are sort of figuring out where the bid and the ask settles, just how far apart are buyers and sellers right now? I've had some private equity people and tell me, everything would clear if prices went down 15%, and the whole market would turn over. But I'd be interested in your view on how far apart people are and how far away we are from matching on transactions.
Thanks, Antoine. Yeah, unfortunately, I'm not sure it's that simple. So there's still a bit of a mismatch. I think probably at least my impression talking to clients is the bid-ask spread, is narrowing, but isn't sort of in the sweet spot yet. So I think it's still a work in progress. I guess, I keep going back to the structures of a typical private fund and the pressures that will eventually apply, right? And so you can do, some of the mechanisms we've been talking around on the secondary side or continuation fund side. If you don't do that, you need to start either getting investor consent to extend your investment period, or you need to start deploying. And so at some point, I think, managers will just continue to do what Christian and Antoine have been describing, which is find those opportunities even in a more difficult market and start to deploying, because you can't just sit there on your hands. That's just not a viable option. So, what we're hearing from clients has changed, even over the last few months in terms of when that deal activity will come back, when that bid-ask spread will get even smaller. It used to be, if I look back, 6 months or so, it used to be this fall. That's obviously not happening, and now we're hearing sort of second half of next year, possibly even into 2025. So it's still a bit of a moving target.
So people are pushing their time horizons back is the general trend you're seeing.
Yes.
And does that mean that at the end of that, everyone has to dive in sort of at the same time, or like, is this, this capital sort of is a bit of a use it or lose it in some sense? At the end of the day, I think there is a time period, right?
There is, and I don't think everyone's just going to plow in because they've reached the end of their investment period. It's, I think, a bit more nuanced than that. But yes, that dry powder that we keep referring to is building up. There's an imbalance in that equilibrium between fundraising and deployment, and that number's just getting bigger. And so at some point, something needs to give, right? So it's not all going to dump in immediately, but I think those pressures will continue to bid and force more and more parties to the table around valuations that actually work for both sides.
Sure. And to bring Jen back in, one of the questions I think we're all debating in the newsroom is, have interest rates even settled out? And, is there still another leg up in this adjustment? So what are you sort of seeing in terms of like where this new normal will settle out? And that has a big impact on whether people will come back in from the sidelines to do deals or whether they'll be forced to. So just tell us a little bit about what you think, where you think, our new normal is going to settle out.
Well, I think Kai's point just then about everyone pushing out their time horizons is really interesting, because that's kind of, to me, that's this realization that, as I said, rates will be higher for longer. Now, even if the Fed doesn't raise much from here, we've still got the possibility that the Treasury market starts worrying about the deficit, which frankly they should be worried about, which would push up yields further. Corporate credit spreads have remained pretty tight; those could blow out. So, the newsroom, we're always thinking about what could surprise us or what might come next. And we often look for the worst case scenarios. So our perspective is always different from those who are doing it. But I think the main thing is we've still got that realization needs to sink in that this might be the base point. 4 or 5% on a 10-year Treasury is still a long-term average. but we're used to them coming down. As soon as the economy softens, we're like, great, interest rate cuts, here we go. I don't think we're going to see that this time because inflation is still sticky. So that's still part of this realization, this pushing out of horizons, which means that everything is taking longer. And we talked about real estate, and obviously that's a slow-moving market as well. It just is. So lots of this stuff will take a long time to work out. I mean, we had so many years since the global financial crisis of super low interest rates, which was a great environment, and there were some great deals done. But there's also some stuff that still needs to be worked out, and that's got to come out, and that just takes time.
Yeah. So I want to switch gears a little bit, and one of the areas where there is a lot of new money coming into private markets is the retail investment channel, and that's it's a market that many firms have really bet a lot of their future growth on, because the institutional investors have become a little bit overweight. And so, Christian, I just want to hear your view on, is the retail channel really an area where you think the new liquidity coming into the private market could really create a lot of opportunities and sort of be helpful in having new money come in that allows transactions to happen?
Yeah, I mean, if you look at the projections for our the whole private markets industry, it's expected to double by 2030 and double again by 2040, and the lion's share of that growth is going to come from private wealth channels, retail investors from all over the world. And at the end of the day, where's most of the capital coming from today? Well, it's actually pensioners and pension funds, et cetera, or insurance companies from around the world as well. So this is just opening another channel for capital to move into an industry which delivers higher returns for savers. So I think it's a very good thing, and it is something that's been, where the regulators are actually working to facilitate that. The notion of accredited investors, et cetera, making it a lot easier for the average saver actually to start investing in products. Now, because it leads to some new dynamics. It leads to products that are more liquid than a typical closed-end fund, and it leads to a need for monthly reporting instead of quarterly reporting, and more transparency, and a bunch of other things that I think is going to be pretty dynamic, and then putting some pressure on a number of companies out there, a number of firms in the industry to drive change, and that's always going to be, I think, for some scary, and for others a real opportunity.
Yeah, and Kai, we were talking about this a few weeks ago, but there is a bit of an inherent tension, because you're bringing private investment strategies to a more broad investing public. And I think, as you were saying, the key to private markets in some respects is the private part. So just walk me through what you see as some of the tensions that come into play with these new funds, which are such an important growth avenue for the whole industry.
Yeah, you're absolutely right. I mean, transparency plays into this. I would say, however, that private markets today are more transparent than they've ever been. In the 25 years I've been in this industry, this is the greatest level, I think, of transparency that's existed, and that's been driven by regulators. It's been driven by investors, but we've been on this sort of journey of greater and greater transparency. I think if you look at the retail angle, and just diving into a point that Christian raised, we use retail, but maybe democratization is a better word, because it's not really the moms and pops in the street that we're talking about accessing. It's really, private banks, wealth managers. So it's, high net worth investors, family offices. It's people who are fairly sophisticated and can take a bit more risk than your typical retail investor. But that being said, it does still create, some of the issues Christian was talking about. I agree completely around liquidity, and there's a bit of a mismatch there. We've got an illiquid asset class, generally speaking, closed-end funds, and then these investors requiring some level of liquidity windows. There's the regulation point. Obviously, private funds traditionally have been unregulated vehicles, and this would be moving them into the more, semi-regulated or regulated space, and how to deal with that. And there's been, I think, quite a lot of creativity, innovation by managers and regulators to make this possible. We've got LTIFs, to use an acronym, so European long-term investment funds that are being further developed to allow passporting to retail investors in Europe. And then, of course, I think there's the access point. So historically, it may have been harder to access these types of investors, but there's now increasingly intermediaries there to provide that access, and some of that's digital. So there's a number of startups, larger than now just startups, providing access to folks through digital platforms to these sorts of products as well. So those are some of the challenges originally in tapping this group of investors, and some of the progress that's been made.
Yeah, that's great. Antoine, you mentioned some of the digital channels you have, but I'd actually be more interested, what Christian and Kai have said is that there is a bit of, in some examples, an asset liability mismatch. Have you found any opportunity from some of these funds, and do you expect to see anything coming from those funds, given that there's ways you can be tactical, you can be a lender, you can do all kinds of different things, but there are inherent trade-offs in the funds, and so I'd be interested to your view.
Maybe I start with the first comment. It's going one direction. As a matter of fact, 22% of our AUM is coming from retail investor, direct and indirect, and probably the average peer is probably 10%, because from Juneau, Alaska, to GIC in Singapore, to a French insurance company, it's at the end of the day, it's private investor money embedded into different vehicles. So I think the retail is moving fast. Obviously, it's probably less sophisticated. And when you talk about retail, it's ranging from ultra high net worth individual to moms and pops. So it's different thing, and you can tackle that direct and indirect, and it's private bank, it's digital platform, it's IFAs, it's unit-linked product, and it varies from around the world, because 401k in the US is not really unit-linked product in France, for instance. But I think it's accelerating, no doubt, because there is a need for diversification. Not sure that there is more risk into private asset than public asset, or at least it's less volatile. But obviously, retail investors are entering, or have entered probably at a late stage of the cycle. So to answer your question, there will be probably a need for liquidity. And I was mentioning real estate fund, retail fund. It's true all around the world. You've got a very large queue of people who wanted to exit. And that's true in the Nordics, in continental Europe, in the UK, in the US. So that's probably create a set of opportunities, but you want to make sure that there is not much trouble, because then you will start seeing a retail investor not really super excited by private capital opportunities. So I think very important to be cautious and to avoid any mis-selling. And I think we are going to start seeing a very large number of mis-selling when it comes to retail investor, especially in the semi-liquid bucket.
Can you say anything more there that's provocative on that very large trouble? Just say what you mean a little bit more.
No, it's very simple, and it's public. You've got some very large real estate fund whereby you cannot exit, and the money is coming from the retail. And I think, obviously, if you have only 50K of savings and you put that on a semi-liquid real estate fund and you cannot exit, and you have to wait, and you need the money for your children, for health problem, it's creating trouble, no doubt. And I think, unfortunately, it's happening in some part of the world already.
Okay, and one final thing for you, Christian, before we go to the audience questions. Are there places you think are better designed for retail in places where you get more worried? Like, again, when we think of the trade-offs, the asset potential liquidity mismatches, asset liability mismatches, where do you see that?
Yeah, I think it's a we'll have to find this balance, right? You're going to have a fund. If you have a closed-end fund, which is typically what we have in our industry for now, and then more and more is going open-ended. If you have a closed-end fund matched with some private individuals that would want liquidity, that becomes a little bit complicated. So you actually need real expertise. You need portfolio management. You need liquidity management. You need a whole new set of capabilities, a lot more robust reporting. And I think marketing, to Antoine's point, how this is marketed, do the buyers of the product actually understand that, yes, it's not liquid, it's semi-liquid, and semi-liquid means that you might not get your liquidity for multiple quarters or even years, even if you would like it, because there are gating systems, et cetera. So there's a lot of education that's needed, and a lot of cooperation between those producing the products, who are us, and the distributors of the products, which are today either the digital guys or the private banks, and that's essential. And there are some test cases out now that are a bit challenging, and I think that's good. So we got to break through some of those challenges and find solutions, because the democratization is important. The savers need returns.
We have a question from the audience, and this is for anyone to take. Can structure, earnouts and things like that, bridge pricing gaps right now? What are you all seeing? I'll just leave it to anyone to answer.
Yeah, I can jump in if you want. Yes, this is a time where, as we talked about a little bit earlier in the call, different types of solutions, whether it's different financing solutions or time or earnouts or vendor notes, which was a big thing for a long time. All these things are coming back. Partnership deals, some of the carve-outs will probably be like that. You'll pay a part in cash and part with equity and part with vendor notes and some financing and a bunch of things. So yes, the whole toolbox is being used again. And I think that's going to happen for some time until we get that stabilization we're looking for.
Okay. Anyone else on that? All right. Well, I think this was a very lively discussion, and it was a great recap of this reset that we're seeing in financial markets and how it's manifesting itself in the private markets. I'd like to thank Christian, Antoine, Kai, and Jennifer for joining us and for being on this panel. And so thank you very much.
Thank you, Antoine.
Thank you. Thanks to all of you.